Going into the year of the rat, while most of the central banks will be on hold, we believe the pace of easing is likely to continue in China, with the PBOC playing catch-up with the rest of the world in terms of monetary policy. But rather than widespread, across-the-board easing, measures will be surgical, targeted to key sectors as reforms, transformation of the economy, and deleveraging will continue. On the monetary policy front, targeted liquidity injection, prudent cuts in benchmark rates will ease overall borrowing costs to offset the downside risk to the economy. Reforms will progress in order to improve the so-called transmission mechanism to the private sectors and to the real economy. The currency, RMB, should be supported by inflows both in bond and stock market, a weakening dollar trend as global risk recede. A reprieve in China-US trade tensions should also help the currency, which has underperformed other Asia peers in 2019. RMB sovereign bond valuations are very attractive, especially when considering the fact that a quarter of global bonds are offering negative yields. Even after hedging of the currency risk back to US dollar or euro, RMB bonds offer substantial yield pickup. The low correlation with the other asset classes make it appealing from a diversification standpoint. On the corporate side, China dollar bonds enjoy the so-called Asian premium, as they offer attractive valuations, good liquidity with a shorter duration when compared with US credit market, dollar emerging market, or euro credit. Despite all the news headlines, the default rate in China is still relatively low, at around 1.2% of the total onshore bond market in 2019. Nothing systemic, a phenomenon limited to the weakest part of the economy. On the other hand, the risk of contagion is also quite limited, as majority of the defaulted bonds was under the form of private placements. Default rate in China dollar bonds is expected to be stable and mainly isolated to some higher industrial names or weaker SOEs, LGFVs. Excluding those distressed sectors, the fundamental of China dollar corporates are actually quite healthy. In this complex Chinese corporate environment, our onshore-offshore cross-border credit research platform and our unified investment process are essential to navigate a more selective and more discriminative market. In 2019, we saw a significant pickup in the usage of Bond Connect, harmonization of access channel to the onshore bonds, and index inclusion by Bloomberg Barclays. As a result, international participation in China onshore bonds have picked up in momentum, pushing the total amount of foreign holding to exceed the 2 trillion RMB mark for the first time. Following Bloomberg Barclays, JP Morgan will take similar step to add onshore bonds into its GBI-EM index from February 2020, which could translate into $3 billion per month of fresh inflows. While China is facing both internal and external challenges, the policymakers will continue to carry out structural reforms and deregulate domestic markets in order to attract international participation.